Hi, I'm Jimmy. In this video, we're going to walk through my top 4 energy stocks that could be a good buy now that oil has crashed, and quite frankly, oil's become super volatile and difficult to predict. So hopefully these 4 energy stocks could fit somewhere, or some of them could fit somewhere in each of our individual portfolios, ideally getting us closer to our goal of achieving financial freedom. Okay, so the first energy stock I think that looks interesting is the Royal Dutch Shell Company. Ticker symbol RDS. Now they actually have 2 different classes of shares, Class A and Class B. Class B comes out of London and are probably the best shares to get into, especially if we live here in the US. Class A shares are subject to certain Dutch laws that can, quite frankly, cause some additional tax consequences. So the ticker in the US would be RDSB, might be /B or .B, or if we're in London, it's just RDSB. Okay, now Shell is actually going to report earnings this coming Thursday, and these earnings could be bad, so I think we need to be ready for a potential pullback in the stock. But one bright side of Royal Dutch Shell is that thanks to this pullback in the stock, they have a trailing 12-month dividend yield of more than 10%. So they've been paying a quarterly dividend about 94 cents per share, and when they announce their next dividend, our real question is, will it still be 94 cents? And I'm not sure it will be. It probably shouldn't be, since we know that the earnings and free cash flow are going to take a hit. Perhaps something closer to the 75-cent range makes sense, although companies often don't want to lower dividends, so they might keep it there if they're able to. But either way, I think that they are going to likely remain having a very good dividend over the long run, and this could work out very well for us dividend investors. Now, from an operational standpoint, Shell and a lot of the other big players in the industry should benefit, or at least be less hurt by the fact that their upstream business is likely to take the biggest hit with this pullback in oil prices, while their gas business and their downstream businesses, although they're probably going to get hurt some as well, they won't get hurt nearly as bad as their upstream business. So the fact that they are diversified is very helpful. And just so we're all on the same page, when we talk about upstream, we're referring to companies or the pieces of companies that explore and drill for oil and gas. Then midstream are companies that transport and store commodities, and then they have downstream, and those are the companies that are refining and ultimately selling the commodities to the public or to airlines or wherever it might be. So clearly the huge drop in oil is going to hurt the companies that drill for oil the most. But many of their other businesses will survive a bit easier than the pure upstream guys. Okay, now the next energy stock that I think looks interesting is ConocoPhillips, ticker symbol COP. As we can see, ConocoPhillips stock has been cut in half since the tail end of last year. And once again, this helped push their dividend yield towards the 5% range. Now, when we switch over to their dividend chart, well, now we can see that they dropped their dividend back in 2015 and 2016, back when oil ran into trouble back then. And I also want to point out that these dividend charts, the ones that I'm using in this video, these are trailing 12-month dividends. So the most recent line, well, that represents the slightly less than $1.50 that they paid out over the past 4 dividends. So it's sort of a rolling number. Okay, now one of the things that I like about ConocoPhillips is that they're doing a good job of cutting their capital expenditures to try to save costs. I think that this is a smart move and should help them during these crazy times with oil. And they're not doing any stock buybacks, so clearly that's a smart move right now. Now, it looks like for this company in particular that they need to get oil to about $30 a share to cover their operational expenses, and about $35 a share to cover their operational expenses and their dividends purely from free cash flow. So our question is, where do we think oil is going to be in the next couple of years? If we think it will get to $30 or $40 a barrel, well, then it makes sense for ConocoPhillips it makes sense for us to add ConocoPhillips to our portfolio. As long-term investors, the pullback in the stock could be exactly what we're after. Okay, now let's jump over to our next dividend-paying energy stock. Next up, okay, first off, I know I'm running through these companies fairly quickly, and some of them probably deserve a deeper dive. So if you have any favorites that you think I should analyze deeper, even if it's not on my top 4 list, please let me know in the comments below. We'll see if we can put one of those together. Okay, next up is one of the more interesting energy stocks during this time, and that is Cabot Oil Gas, ticker symbol COG. Now, when we switch over to COG's stock chart, well, we may notice that their chart looks significantly different than many other energy stocks that we may have seen. Now, they only have a dividend yield of about 2% right now, but I also think that they have a chance to continue to improve that dividend yield. Here's their dividend chart. Especially if we get lucky with this and the stock pulls back, well, that will only improve their overall dividend yield. See, Cabot has a relatively strong balance sheet compared to many of their competitors. They have a decent amount of exposure to some onshore natural gas, which hasn't been nearly affected as many of the as oil has been. And that should do a good job of continuing to push their revenue, at least at a reasonable pace compared to the industry. And they've done a good job of lowering their costs. So overall, I think that they're one of the stronger energy companies out there, hence the reason their stock hasn't really pulled back. So I think in the long run, Cabot could be a company that, although they don't pay a great dividend yield, they do come with a certain amount of security that is a little bit away from the current turmoil in the markets. So I think that there's a bit of built-in safety, but you got to give up some dividend yield for that. Okay, now we shift over to a midstream company that is also yielding in the 10% area. Now this is Enterprise Product Partners, ticker symbol EPD. Now we can see on EPD's stock chart that their stock has been hit like many other energy companies over the past few months, and that's helped fuel their impressive dividend yield. Now we can see that their dividend yield has been gradually rising, which is a good thing for dividend investors, and I think that it could keep rising over the long run. In the near term, I'm not 100% sure. I do know that they have multiple income streams and they have solid credit and liquidity. And in the near term, I think that they should do okay. They should at least survive through these turmoil times. But in the long run, I think it could make sense to pick up EPD for the dividend yield alone. And even if they just kept their dividend close to the current level, it could shake out to be a decent investment, a decent dividend play for anybody looking to expose himself to some energy stocks. Now, they also report earnings this Thursday, so we may get some volatility around those earnings. But I'm looking at all of these companies as potential long-term investments. Now, if we like dividends, but perhaps we don't want to take a chance with the energy stocks, well, I actually did a video not too long ago where I walked through my 5 favorite dividend stocks, or 5 of my favorite dividend stocks that could be good for long-term investors. If you're curious, perhaps that could be a good next video for you to watch. There's a link right here. There's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.